The stock market has been a bit volatile of late, and one reason that could be behind this volatility is a new regulation that is coming in effect to govern high risk foreign portfolio investors. The regulation is aimed at making FPI investment in the Indian capital market very transparent so that the identity of the ultimate owner of an Indian stock can be clearly established. I'm talking about SEBI's norms on clear disclosure of ownership of FPIs as well as the ownership of offshore derivative instruments or ODIs, which are also known as participatory notes or P notes in market circles. But Yash, before we go any further, we have to keep this simple. Please start by explaining to our viewers what exactly is this P note or this ODI.
Well, a P note or an ODI, just to simply put, foreign investors who do not want to be registered with market regulator SEBI here in India can use the instrument of participatory note, or as they're now called, overseas derivative instrument, to access the Indian equity market. These P notes are issued by market regulator SEBI to registered foreign portfolio investors.
Absolutely. And I must point this out that P notes have historically been opaque instruments, but SEBI has been pushing hard to change this, and it's asking for details of the ultimate end beneficiary, the person who's finally going to be holding the Indian stock. In fact, last year in August 2023, SEBI put a deadline to this as well. Yes, tell us about that circular and what exactly it mandated.
Well, Surbi, you hit the nail on the head. In August 2023, SEBI came out with a circular stating that certain high-risk foreign portfolio investors will have to disclose the ultimate beneficial ownership behind the offshore derivative instrument which has been issued by that respective FPI. Now, these high-risk FPIs have time till January 31st, which is another 6 days from today, to provide details, disclosures, failing which the FPI will have to lower its holding till it comes out of that high-risk category.
I have to ask you this obvious question. What is high risk? What is this high risk category?
Well, SEBI is very categorically and on a very objective basis defined high-risk category. FPIs, which have 50% of their India AUM in one single corporate group, or over 25,000 crore of AUM in India, will be considered as high-risk foreign portfolio investors.
Okay, so that very clearly lays out the definition, but we also need to put some context here, which is really important. Now, according to market estimates, only 4 to 5% of the total number of FPIs which are registered in India are believed to be in this high risk category. According to SEBI's own assessment, as of March 2023, only 6% of the total foreign investor equity holding in the country was classified as high risk. And even some of the so-called high-risk investors, they're actually exempt from these new disclosure norms. Yash, tell us more about the guys who are exempt.
Well, that's exactly what it is. Despite being in a high-risk category, you can still be exempted from giving these enhanced disclosures with market regulator SEBI. These are some entities like government-related entities, be it central banks, sovereign wealth funds, pension funds, public retail funds, FPIs having a broad-based pool structure with widespread investor base, also ETFs with less than 50% exposure to India and India-related equities. Not just that, FPI's holdings in an Indian corporate is below 25% of its overall global AUM at a scheme level, or whose India equity AUM is below 50% of the global AUM level at a scheme level, will also be exempted. It doesn't end just there. FPIs which cannot liquidate their position due to various reasons, be it IPO lock-ins, be it moratoriums, will also be exempted from this particular category, which is to give these enhanced disclosures to SEBI.
Okay, so fair enough. First of all, the universe itself is small. As we said, 6% of the total foreign holdings, equity holdings. And within that also, you have all of these categories of foreign investors that are exempt from the new rules. So that brings us to the key question. Given all the exemptions, what is the actual impact? Well, the question is whether a lot of FPIs really have to sell their Indian holdings to meet these new norms. Going by the latest discussions that we're picking up, this doesn't seem to be the case. It probably won't be as market disruptive as what had initially been feared.
Well, that's exactly what it is. The fear is much higher than what the actual situation is at the point. The impact on the market seems to be quite negligible at this moment, simply because of the wide timelines itself. If an FPI does not give the required details by January 31st, then it has another 10-day grace period, failing which it has another 6 months to liquidate its holding to a point that it comes out of this said high risk category.
Okay, so that means that one doesn't have to go tomorrow and sell all their holdings in the market because, oh my God, you're high risk and you're exceeding the threshold. That kind of puts it in context. Now, while all of this is true, we must also remember that this is an ongoing issue and one that SEBI is watching very, very carefully. The regulator's intent is very clear that it wants more transparency and more disclosure with respect to the actual foreign holders of Indian equity. The coming days will probably bring more clarity on which FPIs actually decide to sell down their holdings in order to remain incognito, and the ones that decide to come clean on the real ownership details.